Have you ever taken a position in the market, set your stop loss perfectly, only to watch the price dip down, take you out, and then immediately reverse in the exact direction you predicted? It literally feels like the market is targeting you personally, right? Well, beneath the chaotic, flashing surface of retail trading lies a completely hidden world, a quiet, heavily calculated world of institutional whales, hedge funds, and massive capital orchestrating the very currents we all swim in. We're going to decode this institutional whale flow and finally reveal the ghost in the financial machine.
I want you to ask yourself a deeply provocative question right off the bat. Are you the hunter or the liquidity? Because in financial markets, money doesn't just magically materialize out of thin air, it's transferred. For massive institutional players to buy, somebody else has to sell. If you're out there operating with a reactive, emotional mindset, chasing green candles and panicking at the red ones, you're the prey. You are the liquidity.
Okay, let's dive into this. Section 1. The market's hidden matrix. To actually become the hunter, we first have to realize that the traditional market charts that, 90% of retail traders rely on, they're basically an illusion. To see past the noise, we have to completely rethink how we look at volume. Vertical volume, those standard bars running along the bottom of your screen, that's the illusion. It's chaotic, it's reactive, and honestly, it only tells you when a lot of trading happened, which just breeds frantic anxiety. But horizontal volume, that maps volume to price, not time. And that is the reality. It gives you this surgical precision, showing you exactly where massive money is just patiently parked. Moving right along to Section 2, spotting the invisible whale. So, if these massive institutional players are moving billions of dollars at a time, how do they stay hidden without immediately tripping the alarms? Well, the first footprint you gotta understand is the iceberg order. Imagine a whale wants to buy $1 billion of an asset. If they drop that order all at once, the price absolutely skyrockets and they get a terrible average entry. Obviously, they aren't going to do that. Instead, they use algorithms to mathematically slice that massive order into thousands of smaller, completely hidden pieces. To a retail trader just staring at a regular chart, it just looks like boring, sideways price action or standard consolidation. But underwater, the smart money is quietly accumulating a massive position.
Now, what's really interesting is that we can actually map those icebergs using horizontal volume. The absolute peak of that volume is called the point of control, or POC. You can think of the POC as a fair value anchor. It's the exact price level where whales have historically committed the most capital. And because of the sheer size of the money parked there, it actually acts like gravity. It becomes this magnetic hub, constantly pulling the price back to the exact level where whales are fiercely defending their entries. Building on that magnetic hub concept, we get the value area. Get this, 70% of all real heavy-hitting institutional positioning happens within a very tight, highly concentrated, invisible corridor right around that point of control. The other 30%, that's just the Wild West. That is chaotic retail action, emotional spikes, and pure noise. The real trading, the kind that actually moves markets, happens almost exclusively in that 70% zone.
Which brings us to Section 3, the 2026 liquidity grab.
Understanding these volume zones perfectly sets up the modern tactics whales are actively using right now. This is the defining trend of the 2026 market. Remember those perfectly set stop losses we talked about earlier? Whales deliberately orchestrate these brief price sweeps right below established support levels. They shove the price down into what we call low-volume voids. And why do they do this? Because resting just below that support is a golden pool of retail stop losses. When those stops trigger, it creates a massive flood of automatic sell orders. The whales use that exact moment of retail panic as the liquidity they desperately need to fill their huge buy orders without rocketing the price upward. It sounds ruthless, right? Because it is. This is the predator's playbook. Armed with immense capital, whales can essentially incite panic buying and selling at will. They can paint the tape, which means executing strategic trades just to make the chart artificially look incredibly bullish or bearish, specifically to trap algorithmic bots and retail traders. And perhaps most profitably of all, they actively hunt down over-leveraged traders, intentionally triggering short or long squeezes to force liquidations. They are literally feeding on the smaller players. But, and this is absolutely crucial, whales are not invincible gods of the market. They have very strict limitations, and knowing these limitations is our edge.
First off, they are simply too large to fly completely under the radar. Their massive volume will always leave a footprint if you know how to read it. Second, they face severe legal and regulatory risks when it comes to blatant manipulation. And finally, while they can easily manipulate short-term price action to grab liquidity, they cannot easily alter long-term macroeconomic trends. Eventually, even the biggest whales have to swim with the larger macroeconomic tide. Okay, Section 4, Surviving the Retail Trap. Now that we understand their playbook and their limitations, how do we actually survive the specific traps these institutions set? Like, how do you tell the difference between a real move and a trap? Well, a genuine institutional move has a high-conviction volume signature. We're talking thick, heavy horizontal clusters perfectly aligned with a point of control, which results in a sustainable trend. A retail trap, on the other hand, is just a low-volume pump. It looks like this really exciting impulsive breakout, but underneath, the volume's practically non-existent. It is mathematically destined to fail. And this brings us to a really harsh reality of trading. Breakout patterns, the exact patterns taught in pretty much every beginner trading course, are frequently just engineered illusions. When price breaks out of a long consolidation phase, retail traders get super excited and rush in to buy. But remember, for every single buyer, there has to be a seller. Whales will deliberately push the price just over that breakout line to generate a frenzy of retail buyers, simply so the whales have enough exit liquidity to dump their own massive accumulated positions at a profit. All right, Section 5, Hunting with the Heavyweights. Time to go on the offense. So, we've learned how to defend against their traps. Now, let's pivot. It is time to stop being the hunted and start hunting alongside the smart money. Your absolute best weapon in this hunt is the fixed range tool. While standard volume profiles show you the entire chart, the fixed range lets you isolate very specific, boring, sideways ranges. By dragging this tool over a consolidation phase, you instantly scan those dark pools of accumulation. It basically peels back the curtain to reveal the true buy-side versus sell-side absorption happening right in that very moment. Let's see how this builds into a heavyweight execution checklist. Step 1, patience. You have to wait for the price to return to a high-value node, like that point of control we talked about. Step 2, align your trade purely with high-conviction volume clusters. Step 3, and this is vital, set your stop losses in volume vacuums. These are the low-volume areas where institutional support mathematically just doesn't exist, meaning if the price goes there, your thesis was wrong anyway. And step 4, only ever execute in the direction of the smart money flow. I want to leave you with this exact quote from our analysis of market dynamics today. Whales are extremely financially potent market participants, but they are not perfect. It's far easier to orchestrate short-term manipulation than it is to actually alter the long-term trend. Let this be your guiding philosophy. Don't try to fight the whales in the short term, but also don't assume they can fight the broader macroeconomy in the long term. Find their footprints, understand the traps they set, and just ride their massive waves. Ultimately, mastering horizontal volume profiles and truly understanding institutional flow is the only way to permanently escape the retail trap. Take this final thought with you every single time you open up a chart. If you can't see the liquidity, you literally are the liquidity. Thanks so much for joining me today. Stay sharp out there and happy hunting.